Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Buying a property is exciting, whether it's your first home, your first buy-to-let or your next investment. Most of your attention goes into finding the right property, negotiating the price, arranging the finance and planning what comes next. One of the most important parts of the entire process is often left until the last minute, and that's buildings insurance. Unfortunately, it's usually only after something that goes wrong that people realise just how important it is. So today I want to talk about buildings insurance, why it's important, when you actually become responsible for the property, some of the common mistakes we see investors make, and a few things that made experienced landlords always think about. So let's jump into this then. We've got 9 steps in this process to help you understand what buildings insurance looks like and why it's important and things to consider. So part 1 is what is buildings insurance? So this is the basics, just covering off what it actually covers. Buildings insurance protects the structure of the property. So the easiest way to describe this is if you were leaving a property and you were leaving it, if you're selling it and you're leaving behind, it's anything that you can't take with you. Another way to think about it is if you were to pick the house upside down and shake it, nothing would be left in to fall out. Those would class as contents. So those are your walls, your roof, your floors, your windows, kitchen, bathroom, anything that's permanently fixtured down, that would fall under it. And then what it would cover is things that this type of stuff would be caused by it. So your fires, your floods, your storms, escape of water, impact, damage, subsidence, if it's covered, and we'll talk about that in a bit. The purpose isn't to ensure what you paid for the property, and this is a common misconception, is to ensure the cost of repairing or rebuilding it if something catastrophic happens. So for instance, a house is a house, whether it's a 3-bed detached house in South Wales versus the middle of London. The insurance doesn't take into account the value of the land. So people often sort of mistake the value of the house, but the cost to rebuild those houses should be pretty much the same. Yeah, in London, it would probably be more expensive due to access and parking restrictions and depending exactly where it was. The cost of labour and things, but the overall cost wouldn't be materially different. So it's the rebuild cost. So if the house was to burn down, how much is it to rebuild a house? So that's step 1. That's what it is. Part 2 is around when does your responsibility actually start? Again, this is slightly different and catches some people out. So many buyers assume that they only need insurance from completion. A lot of the time, exchange and completion on a purchase happens on the same day. But in some instances, you will exchange on, say, one Friday and then aim to complete the following Friday. Or, for instance, if you buy at an auction, when you win the auction, you've exchanged, and then you may not be completing for 28 days or something like that. Now, when contracts are exchanged, i.e. when you win the auction, the contract states that it's usually you as the buyer that is then responsible for insuring the building from exchange. So if you are buying an auction, then bear that in mind. But also if you are agreeing a purchase under normal conditions and there's a delay, a time frame between exchange and completion, then you make sure that you are responsible. And we've had a buyer in the past selling a property a buyer buying a property, and there was a flood in between the two. There was an escape of water. There was a burst pipe in the bathroom and it was all damaged through the ceilings and everything. It managed to get sorted, but that was something that happened, a real life one that's got caught in between exchange and completion, because these things happen. So if there is a serious fire or anything major in between the two, you are responsible. So you just want to make sure that you've got that lined up properly, and your solicitor should check that it's in place. But people do make mistakes. They're busy. So just make sure you definitely have this in place from the point of exchange. Step 3 is why mortgage lenders insist on it. So the majority of people are buying with a mortgage, and if you are buying with a mortgage, the lender will insist, and they want, they usually want their name noted on the insurance policy as well as an insurable interest, because ultimately, if the house burns down, you still have the mortgage on it, so you may owe a couple of £100,000 or millions of pounds, and the property isn't there anymore. If it's not insured, you still owe them that money, and you're going to end up in a sticky position. So the lenders just want to make sure that they are protected. The security behind their loan is protected. Okay, so if the house burns down and you're not insured, it doesn't mean the mortgage disappears and burns away with it. So this is super important when there is mortgages in place. Step 5, what if you're buying cash? This is a super important one. We see a lot of people probably skip this step, if I'm being honest, with some of the things that I've seen. And so just make sure that it is optional when you buy in cash, but it shouldn't be. Nobody's forcing you to insure it. But imagine if you bought a house for investment property for 300,000, and 6 months later there's a major fire. Then without insurance, you're paying for that rebuild yourself. I actually know somebody who had a building and this actually happened to them. I'm not sure they had insurance on it. There was an arson attack on the building next door, and they had quite a lot of damage on their property, and it wasn't insured. So these things do happen. Even you think that it wouldn't happen to you. These things happen on a daily basis. So if it's your hard-earned money that you're putting into this, or if it's an investor's money or whatever it may be, then you really want to make sure that you are covering this and getting insured. It's a small price to pay compared to the value of the property. Step 5 is, how do investors need to think differently? So not every investment property fits a standard home insurance policy. Obviously, you've got home insurance, which covers the home that you live in. And then outside of that, then you've got different, what insurers will class it as risks. So your standard buy-to-let property would just be a normal landlord insurance policy. But then as you get through the different strategies, you've got HMOs, which will be a separate type of policy. And as you can imagine, 6 people sharing a house with different working or coming out in and out at different times, sharing a kitchen and not really maintaining things as you would if it was just you living in the house. So the responsibility gets shared. Ownership also then gets shared, and people often don't take ownership for things. Holiday lets, as you can imagine, people coming in and out, more volume of people, mostly, they're cooking and things. They don't know how to switch things off properly, or they haven't got the instructions. These things can happen. Serviced accommodation, commercial properties, semi-commercial properties. So flats, below them there's takeaways, there's chip shops, there's hair salons where they've got lots of peroxide, bleach and things, which is highly flammable. So that's quite a high risk property. So all of these things are things to consider. Empty properties where, if the property's empty for a long time, there's risks against break-ins, there's risks against property damage, but also there's risk against water leaking as well, because if a property's empty and nobody's checking in on it, and a water pipe bursts, again, I spoke to someone recently, they'd had something similar, the property been empty for 6 months and the water had been running for 6 months, and there was the whole of downstairs was ruined. So these things do happen. So every one of these different strategies will have a slightly different specialist cover. So if you're investing in property, you need to understand which one of these, and I highly recommend that you speak to a specialist broker, depending on what type of risk you're having within your property. Step 6 would be, the common mistakes that people make. So the first one is, as I mentioned, assuming the standard home insurance is suitable. Most of the time it isn't. If not telling your insurers that the property is going to be rented. So maybe you've had your own residential home and you've moved out for whatever reason, you've bought another house, or you've moved out to go change location with a job or something, and you're going to need to rent your property out, and then you don't tell your insurers, then that could null and void your policy. So you'll be paying for something that isn't even going to pay out. This is a major one, not declaring that you're doing major refurbishment works. Obviously, if you've got a house and it's just on an insurance policy, a normal insurance policy, and you've got workers coming there, maybe they've removed the front door, access isn't secure, there's materials on site, there could be break-ins, there could be flammable materials, etc. So the risk heightens during parts of the refurb. And so, again, this increases the risk. So you need to notify your insurer of any works that are being carried out. Leaving your property empty without notifying the insurer, again, most policies will allow you to not be within the property for 30 days. But if you go for more than 30 days outside of the property, or it being empty for more than 30 days, again, you should notify the insurer as to why and when you expect it to be filled. And they may or may not cover you during that time, in which case you'd have to take out a different cover. And then another sort of major one is underinsuring the rebuild value. Like I mentioned earlier, the rebuild value is not just going into a bit more depth on this, is the rebuild value. You might see them as come up as quite expensive. And if you understand the cost of building things, you'll say, well, there's no way that building, it would cost that much to rebuild it. But when you think about the process of, let's say a house burns down and it's a mid-terrace, you've got the two buildings next door to each other. They may have damaged those buildings, in which case you might have to move all of the people out, and there's a cost to rehouse those people. So then you've got the cost of all of the people. But usually when you see a fire, if you ever drive past a property that's had a fire, I would say there's probably at least 6 months where nothing really happens, and you keep driving past and nothing happens. And because it's going through the insurance claims process, there's so many surveyors, reports, arguments back and forth over who's, the responsibility, and surveys about what works are being done, what aren't being done, who's covering it, who's not, and then having a schedule of works and getting all the costs and materials ordered and everything like that. So to go through that process, you're probably waiting 6 months before anything happens. So on a big, it has to go out to tender via the insurers. So it's the cost of the rebuild is not just the cost to actually rebuild it. It's all of the upfront work that's done by all of those different surveyors and things. Obviously, if there's damage, you'd have to have structural engineers reports and things. The cost of housing people elsewhere, alternative accommodation, and then just going through the tendering process. So it's quite a laboured process, and it's not something that happens overnight. And obviously, the longer it takes, the more costs. So that's a major one, is underinsuring the rebuild value. And obviously, with prices for labour and materials having increased so much recently, you need to make sure all those are in place. And then the final one on this point really is buying purely on price. As with anything in life, you get what you pay for. If you buy purely on price, you are going to get stung when it comes to the point of claim. You want to make sure that you're with a reputable firm that's got a good claims process, that has good reviews in terms of paying out on claims, and they're not trying to minimize everything. And also, what you'll see is that some insurers have 4 different levels. So you might see an insurer and go, oh, I know them, I'll go with them, they're reputable. Whereas you might be going for their basic version, which has got a limited payout or limited amounts under each payout section. And then as you go through the sort of silver, bronze, silver, gold, platinum versions, the amount of cover will increase. So definitely worth shopping around and making sure that you're getting good, solid advice on it. And yes, it seems expensive at times, but compared to maybe some of the cheaper stuff. But ultimately, when it comes to the point of claim, that's when you really value this stuff. Okay, so part 7 is around renovations and empty properties. So this is particularly relevant for investors. Like I said, anyone who's doing any structural alterations, extensions, heavy refurbishments, you always need to speak to your insurer. Some works require specialist insurance, and your existing policy won't cover you. So, like I said, if a property becomes vacant, then that could affect things. So any vacant properties or any renovations, you must notify your insurers so that they're aware, because the last thing you want, you don't notify them, something happens, and then they say, oh, you should have notified us about this, and therefore we are now not paying it. Which again, you can't say you didn't know because I've told you. What happens is some insurers just won't cover you if that's the case, if you're doing refurb or if it's going to be empty for a certain amount of time. The other thing they could do is just put some conditions on there just to make sure that there's regular inspections, that you've turned off all the water systems, there's increased security, and then the various different restrictions, maybe after 30, 60, 90 days of it being empty, etc. But if you don't comply, then claims can become difficult, and that's the last thing you want. So part 8 then is around things that experienced landlords think about. So as your portfolio grows, insurance becomes a bit more intense, obviously from an admin perspective. And so then you start thinking about it a bit more strategically, thinking about what type of properties you're buying, think about leasehold flats. Usually that's covered by the freeholder as part of the service and management charge. So make sure you're not paying buildings insurance for a leasehold flat. Listed buildings, obviously be aware that listed buildings, the refurbs on these can be far more expensive than traditional rebuilds due to the specialist nature of it. Flood and subsidence history. Always understand the previous insurance claims and local risk before you purchase. And this has changed a lot recently. I know in Wales they've changed the flood maps. So now you can go on and search an address and see what flooding is in the area. So one of the things that people do sometimes get caught up on, and this is quite late in the process, when you're buying a property, try and look at the flood maps as early as you can, because if you wait until the day of completion, it might not get picked up. And then as you're waiting to get exchange and complete and get insurance, and then you find out you can't get insurance because it's in a flood zone, that can cause major problems, and you would have spent potentially thousands of pounds to get to that point. So definitely try and get that done as early as you can in the process. Portfolio insurance then. So if you own several properties, it might be worth considering a portfolio policy. So it would be one policy that would cover all of your properties. Just simplifies the process in terms of administration. There's one payment, one renewal date, and then you could possibly get wider cover through the portfolio insurance, and it's easier to add policies on. So that could be something to consider at some point in the future, just to reduce your admin and your overheads. And then just things to think about from an additional perspective. If you've got a property that you're relying on the income, then you might want to cover loss of rent. There's property owner's liability, landlord's liability, legal expense cover, alternative accommodation. Like I mentioned earlier, not all policies come with alternative accommodation. So if there is a fire and it's at your property and it's your fault, you may need to pay for alternative accommodation for the tenants. Again, make sure that's in the small print. And then also, if you are providing a property that's got contents in it, so furniture, if it's a furnished property, then you would want to make sure you got some contents cover in there as well, in case there's damage by the tenants or guests or whatever it is. So not every landlord needs every option, but you should really understand what's available to you for the type of property that you're buying. So finally then, part 9 is just my checklist that you need to consider before every purchase. So every time you want to ask yourself is, when does the insurance need to start? Do I have the correct type of policy? Have I told the insurer exactly how the property will be used? Am I insuring the correct rebuild cost? And you can get that from a RICS calculator online. Have I considered any refurbishment or any vacancy issues? Do I need any additional landlord cover or loss of rent or additional accommodation? And have I checked the flood risk maps? So that's it from me. Hopefully that's been helpful. If you know anyone considering buying a property soon, then please share this with them. Building insurance will never be the most exciting part of buying a property, but it could easily become the most important. We spend so much time analysing deals, negotiating prices and arranging finance, yet something as simple as having the wrong insurance or arranging it too late can undo a huge amount of hard work. So whether you're buying your first property or adding another investment to your portfolio, take a few extra minutes to understand what you're covered for, what you're not covered for, and whether the policy genuinely reflects the way you're using that property and whether it adds any value, and whether it's of value and it's good value for money. Because protecting your investment isn't just about buying the right property, it's about making sure it's protected long after you've completed. Thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.